Hello and welcome to Mutual Fund Talk. This is the 74th year of independence of India. So we have brought in the Independence Day special of Mutual Fund Talk for you. And we have a special guest. Maneesh Dangi is there with us, who is the CIO Fixed Income at Aditya Birla Sun Life Mutual Fund. Maneesh, thank you so much for joining us. First of all, happy Independence Day to you.
Happy Independence Day. Thank you very much.
You know, this actually prompts a question. Are we financially independent enough in terms of the population that invests and the population that needs to invest? What would you say, to begin with?
No, I mean, we are not independent. We are a very poor country. A large percentage of our population remains below poverty line. And, far too few people save in this country yet. So, I mean, as a country, of course, we can't make that point. We made a good start in last a few decades. We moved towards prosperity. Many people are beginning to save and secure their future. So it's a good start, but it's a long way to go.
One of the good things that instruments like mutual fund has done is that you can invest, a very small sum and then still build your future, whether it's maybe midterm or the long-term goals that you have. So in that perspective, I think everybody is making an effort, and with campaigns like Mutual Fund Sahi Hai or the other campaigns that the industry has been running, there has been change. Of course, there's a long way to go. I would agree with that. But this situation of COVID, has that caught people off guard? Many people didn't think of such a situation. They had an emergency planning, but not maybe more than 2, 3, 4 months. So how do you see this? Are people really caught off guard? Or you think India, as a nation which has been traditionally saving a lot, that was sort of prepared?
No, I wouldn't say that we were prepared as a country. Of course, as I said, most people are still on the borderline and literally struggling right now. So it's a very bad situation. Are people off guard? Did they get caught off guard because of COVID? The answer to that is, of course, yes. This is not something in terms of this kind of a pandemic is not something that one would have even imagined when one invested in any asset class. Okay, but the beauty of markets is actually that you could have many reasons of uncertainty, but yet the outcome of drawdown or losses are recurring. Okay, so we saw precisely that. You saw in equity that you had 25, 30, 40% drop across countries, including India, and then you also saw policymakers responding to it and markets recovering. So you could be forgiven to not even know that a pandemic happened. Simply by looking at charts, you would imagine, oh, this must be a recurring phenomena, because this happens every now and then in equity markets. The prices drop and then they begin to recover because of some policy response. So that's the beauty of anything which is related to market. It self-heals. Okay, there are many ways, there are many mechanisms at work which actually begin to heal the market, and which is precisely why investors have to dial markets in form of mutual fund to earn that extra. Because yes, they would stay with a little bit of volatility, but yet over a long period of time, they would earn better returns.
So if we look back at last 4 or 5 months of pandemic and lockdown, what has really been the behavior of investors? I know initially we talked about it when we met last on the show, but now that we have more data and now that we have more experience, you would have spoken to your investors as well. So has as a population, we started paying more attention to build alternative sources of income from financial assets?
So the first response of all cohorts, not just in India, but across the world is, rise in precautionary savings. Okay, because again, something like this once in a life thing happens, and you realize that, you possibly don't have enough saving to last you for long enough, and which is why the first order response is save more. Okay, so which is what is happening across, and the personal savings are shooting through the roof pretty much across countries, including India. Okay. Two is the choice of instrument. This is a reminder that while it is true that the riskier asset class such as equities would actually deliver good returns over a long period of time, but they also tend to be too risky. And therefore, it's a reminder that many investors may be beginning to think that, okay, I cannot stomach this kind of volatility in pretty much 100% of my portfolio, and which is why balancing factors have to come in. Some people are beginning to talk of gold. More consideration is there for fixed income, and so on and so forth. So all that actually, so all these events, which are recurrent, but for every new investor, it's a bit of a shock. It actually what should I say, reconstruct an idea of a portfolio for him. And then, he sort of learns over and over again as to how his portfolio should look like. Every portfolio for every individual investor is tailor-made. I and you cannot tell your dad what percentage of that should be in equity and debt. These experiences teach him that what percentage, he can stomach in terms of volatility. So yes, there are changes. People are, as I said, precautionary savings are rising. And second, is more or less people think that, there should be some balancing ideas, in your portfolio.
Okay. So, one of the things that you just said, the takeaway would be that it's got to be tailor-made for most of the people. It cannot fit in like, one shoe, everybody cannot fit in. But tell me something, within fixed income, there are various instruments that are available that might suit one person differently, or the composition might need to be different for someone another. So how do you then work that out? What's the formula, or what's the way to go about it?
So, fixed income has sort of many horizons of product. See, that's the beauty of fixed income, relative to, let's say, equity. For sure that in no equity fund, you could actually invest for 3 months, 6 months, 1 year. Your investment horizon has to be very, very long. And that's pretty much across. Okay, it starts with 3 year or 5 year. Now, in fixed income, you actually offer someone a product which could satiate for just a 15-day investment horizon, and which is liquid fund. Okay, you have products, which are fine for 3, 6 months, 9 months, up to 12 months. They are called low duration funds. Then you have, of course, funds, which are absolutely okay for 1 to 3 year horizon, which are called short term fund. Okay, so or corporate bond fund or banking PSU fund. So basically, depending upon your investment horizon, you could allocate your money in these category of funds. You also have balancers, in a sense that if you have a lot of equity investment, and as a matter of fact that every 5th year, 3rd year, you have this 20-25% drawdown in equity. Every 10th year, you have 40-50% drawdown in equity. How do you balance that? Okay, so one traditional way of balancing equity drawdown or losses is gold. Because we know that pretty much every time when the equity falls, most of the times, gold rallies. Okay, similarly, you could say that the gilt fund or income funds actually are good places to be, because they tend to do a good bit of lifting your returns, especially when equity returns are falling. Okay, so those are the balancer funds which actually find their place in your portfolio simply to balance the volatility of equity, but then they have to be for longer term horizon. So you can't invest in a gilt fund for 3-6 months. Okay, it has to be longer term horizon, because the key purpose is not to extract more return, but simply to balance the equity drawdown. When I say drawdown, let me clarify. Drawdown essentially means losses. Okay. So whenever equity is losing substantially, if your gilt or gold is there, okay, G for gilt and G for gold, okay, those will balance your returns. In a sense, minus 40% equity, but maybe minus 15 plus 15% gilt, and so therefore that sort of neutralizes the losses. So there are two things I said. One, fixed income across time horizons. So you have for 15-day product to 5-year product. Okay, so depending upon your time horizon, you should be investing. Two, of course, some fixed income portfolios are a good fitment for portfolilos which have riskier asset classes in it, like equity, because they balance the drawdown. So these are the two key purposes of fixed income and how you can look at it.
Okay. In these times when equity was down, the interest rates are also in a cycle where, fixed income securities are probably not looking so great as well. So in such kind of a situation, what does one do?
Yeah, so again, see, fixed income. Yeah, sometimes in last 2 3 years that we have seen is that you make great returns because interest rates come down, and when
Hmm.
interest rates come down, your portfolios get marked to market at higher level. Okay,
Hmm.
and therefore you sort of earn extra return today. But that also means that your tomorrow's returns are going to be relatively poorer. Because
Hmm.
always remember that most of the time interest rates are mean reverting. When I say mean reverting,
Yeah.
meaning in 2014, the 10-year bond was at 9%. Then it fell to
Hmm.
8, then 7, then 6, and then 5.75. Okay. So in last 5 6 years, interest rates have been falling almost
Hmm.
regularly. Okay. Now interest rates have some bound. They cannot go beyond a certain level for an economy. Like in US,
Yeah.
US 10-year bond is at 50 basis points, 60 basis points. Perhaps it
Which is
can't go
hardly
below
anything.
that.
Hmm.
And then, in Germany, it's minus 30, minus 40 basis points. So all of them
Hmm.
have hit levels where they potentially can't go below that. Okay. So which is
Hmm.
why the time of a capital gain, okay, is behind you. When a 10-year bond in India, let's say, fall from 9% to 8%, you not
Hmm.
only make that 9% coupon, but also make a 7% or 6% worth of capital gain. So your total return for that year, in a year when the rates have fallen from 9 to 8, okay,
Hmm.
becomes almost like 15 16%, right?
Hmm.
But then what happens when 8 goes back to 9? Okay, when 8
Hmm.
goes back to 9, you lose that money, okay, because you have capital losses. So you're
Yeah.
right that we, after 5 6 years of a secular downturn in, what do you call it, interest rates, we've come to a
Hmm.
point that the space for more rate cut is not there. Okay, so
Yeah.
now let's talk about the implications for the investors. You
Hmm.
should avoid funds which run high duration now. Okay,
Okay.
high duration. So if you were buying income fund, or you are buying some long duration, let's say dynamic bond fund, only
Hmm.
because you wanted to play duration, okay,
Hmm.
that is avoidable now because duration led gains are behind you. When I say
Hmm.
duration, meaning a maturity of the fund, okay, if it is very
Sure.
high, then it means that when interest rates fall, you will gain. But if
So
when
what would
interest
you
rate rise,
classify the long or high duration funds as? What's the number of years or duration?
so see, income and gilt funds tend to be anywhere between 4 to 7 years of duration. Okay,
Okay.
dynamic bond fund, though we don't run high duration in our dynamic bond fund, but most dynamic bond fund also tend to run relatively high duration. Okay,
Hmm.
so those duration products should be avoided perhaps right now. You could,
Okay.
but there are funds like short-term fund and low duration fund. They are
Okay.
harmless products. If your investment horizon is for 1 to 3 years, if they
Hmm.
frankly don't, they won't hurt you much in this investment horizon, and which is why you could sort of still go there, irrespective of where the irrespective of where the interest rates are, because your
Hmm.
key objective, remember, is from a relative standpoint is to beat fixed deposits. Okay, so if
Okay.
you're coming in a short-term fund, even today, it's likely that over a 3-year horizon you will be able to beat fixed deposit. Okay, if you
Okay.
are in a low duration fund, even today at these levels, you will be able to beat fixed deposit for 6 to 12 months. Okay, so to
Hmm.
that extent, yes, as long as our funds, fixed income funds, are able to beat fixed deposit, you should much care. The only thing that you must know that the very high returns that you earned in last 1 to 3 years in fixed income fund, they will not
Hmm.
recur. The returns will be somewhat depressed in next 1 to 3 years.
Okay. So would you then agree that at this point in time, the idea is more to protect your capital with slightly better returns than maybe looking at high gains, and then those days are probably not right now here, or are
Yes,
gone for that matter.
yes,
So
Naveen.
capital protection, would you say, is the primary objective as of now?
Absolutely, absolutely. So I think it's well put that right now, whatever gains that you made, preserve them.
Hmm.
Fixed income will still offer you okay return vis-a-vis inflation, vis-a-vis fixed
Hmm.
deposit, but then don't look for dazzling high returns now. That's behind, but they will
Okay.
return again a couple of years later. It's cyclical. Okay, so
Hmm.
this should not change your behavior of looking at fixed income. They will return again, but yes, you should embrace lower returns over next 1 to 3 years.
Okay. So then I think these fixed income funds, they can be thought of as sustained alternatives for an alternative income.
Yes, they are, we call it fixed income
Hmm.
because, almost an impression of, you could sort of
A regular income.
extract fixed kind of income from these.
Yeah.
They still tend to be more volatile than, uh, you know, uh, calling it fixed, but yet
Hmm.
far less volatile than, what do you call it, equity or gold or real estate.
Hmm. Okay. Now, also because if somebody is not really that savvy, you named categories. So, I think people would have understood some of the things. But then, is it also good, is it a better idea rather to go to someone who knows it, have an advisor? Maybe it can be a friend or a professional one. So, do you think this now necessitates some sort of an intervention by a professional who knows the subject?
Absolutely. See, fund business or any financial asset is a very, very special skill. Not many people make
Hmm.
money from markets. Okay, so in a sense, it's not that someone can read a newspaper and dial some risk, buy some stocks. It's a very, very
Hmm.
serious business, and therefore, like you are ready to pay, what do you call it, a doctor for an ailment. You can
Hmm.
always Google as to this is what you're feeling and treat yourself. But then everyone
Hmm.
advises you to do otherwise. Go to a doctor.
Yeah.
Similarly, you need to look for a doctor for your money. Okay, who would
Hmm.
perhaps help you diversify, would perhaps help you rebalance your portfolios. He will help you avoid the risk of ruins. He will help you in times when you are likely to panic the most because when your portfolio levels are falling, yeah, and a lot of
Hmm.
newspaper are covering stuff, you want to run from funds. He'll help you not panic. And finally, most
Hmm.
importantly, he'll help you avoid bad funds, okay, which do not fit in your idea of what do you call asset allocation, okay.
Hmm.
Let's say there's a private equity fund. It's done
Hmm.
wonderful, but it doesn't fit. You are a 72-year-old man.
Hmm.
You shouldn't be interested in that private equity fund. Okay,
True.
so
Hmm.
in a sense, for a rich, what do you call, young man, he can potentially dial a lot of risk with very long investment horizon, but that's
Hmm.
not necessary for an old woman. So in a sense, you need that friend or advisor to always
Hmm.
tell you what to do. It's a small fee to pay, but then he plays a very, very important role.
Hmm. Let's come back to the basic question, the idea of investing in the fixed income funds. Now, people have money in their banks. They feel very comfortable. Of course, some time back, even in banks, people started feeling very uncomfortable given some of the uh, incidents that happened or some of the things that happened in the banking sector. Uh, Comparing the two, not in terms of what return they could fetch, the exact numbers or whatever, but comparing the two, keeping your money in savings instruments that are there in, let's say, post office or bank, vis-a-vis your fixed income securities or fixed income funds. How would you say that the mental preparation needs to be made? Because risk is there in both. You would have interest rate risk in one category. You would have probably the risk that you've seen in the banking sector on the other hand. So, is there also a balancing that needs to be required to be done?
What shall I tell you? No rich man invests in fixed deposit. That's a secret. Okay, so if you want to be rich, you cannot be investing, or you won't be investing in fixed deposit. No one does that. I can assure you that Naveen doesn't have a buck in fixed deposit, and nor does
Well, you're
Mr.
right.
nor does Manish or anyone else in this group. Okay, why is
Hmm.
that? Because people who know this that not just return, okay, which markets would always offer you, but also this convenience, the liquidity, the tax incentives, beating the
Hmm.
inflation, being mobile enough. All of these are the attributes of market oriented products. Market
Hmm.
today is offering you everything. Today you have a liquid fund which on last 15, 16 years, the top five, I'm not talking about Birla here, the top
Hmm.
five fund houses on an average, in last 15 years, 16 years have delivered near fixed deposit like returns in even liquid fund. A liquid
Mm-hmm.
fund which barely loses money even one day. And if you're
Mm-hmm.
invested for 7 days or 15 days, it almost never loses money. It's
Mm-hmm.
almost like a daily fixed deposit, which you can withdraw your money anytime you want. Plus, if you stay
Mm-hmm.
invested for 3 years, you get big tax incentive. Remember,
Okay.
the investors have 2 or 3 demons to fight. Okay, one big demon is tax. Okay,
Hmm.
if you don't hide your money in right platform, okay, hiding is
Okay.
not evading. Okay, hide
Sure.
meaning placing it in the right fund or right
Hmm.
platform. They will take it away, okay, which is the tax
Mm-hmm.
officers, because you put in fixed deposits. Naveen is in a 40% tax bracket. 40% of the money would wither every year for
Hmm.
you make 5% in fixed deposit, 40% of that will be taken away by tax authorities. Why would you
Hmm.
do that? Put in fixed income fund, even in liquid fund, stay there for 3 years, then number drops to half, the tax
Mm-hmm.
drops to half. The second biggest demon is inflation. Okay, it
Hmm.
is eating you every day, your money every day, because the what do you call the consuming power of that same $100 today is not going to be there tomorrow. So, but the
True.
fixed deposits don't deliver you real returns. Why don't they
Hmm.
deliver? Because this is their business, not just in India. You know that today, if you are in United States, a 1 year fixed deposit is going to earn you about 15 basis point. Okay, so nothing, zero returns. And financial repression, meaning not giving returns to what you call fixed deposit
Hmm.
investor, is not just an Indian phenomena and not just today's phenomena. It's never been there. In last 40 years, the real return of a fixed deposit in India is near
Hmm.
zero. So this
Mm-hmm.
debate is settled. Naveen, you have to convince today everyone that please, if you want to hide from taxes and hide from inflation, secure yourself from inflation, you have to
Mm-hmm.
come to market products. When I say hide, again, I want to sort of clarify, hide again is not evading, hide meaning that
Sure.
more tax efficient vehicle, okay,
Hmm.
which is fixed income fund, equity fund, any other fund, it will tax you less. It will prepare you with better returns vis-a-vis inflation, and it will also, more importantly, give you liquidity anytime. You put money
Mm-hmm.
in low duration fund, 15 days later you say, no, I need my money back. No penalty,
Mm-hmm.
nothing. You can withdraw your money. So much convenience. Everything's there on app now. That so many
Yeah.
people have come up with the app. So arguably the fixed deposits key characteristic was that a friendly neighborhood face. Okay, that you
Mm-hmm.
could go to a bank manager and say, "Sir, मेरा 10,000 रुपए आप deposit कर दो."
Hmm.
Okay, you can swipe on your web, what do you call app, and you can deposit 10,000 rupees in Birla liquid fund or any other liquid fund. So in a
Hmm.
sense, even in convenience, the market products are actually ahead now. So my
Okay.
submission to investor on 15th August is that free yourself from this notion that fixed deposit is the only place where you can hide. Okay,
Mm-hmm.
because that's inefficient, more both from tax and inflation standpoint. It is
Hmm.
less convenient than what you could potentially sort of do with your. And there are many options in fixed income funds, or equity funds. There are 40 fund houses.
Hmm.
There are many Naveens, who are actually addressing the need of people that, okay, which fund you should come and not go. Okay, so
Mm-hmm.
my submission is that yes, do use fixed income platforms or fund platforms to sort of diversify and allocate your capital, not just fixed deposits.
Sure. Now let's move a step ahead. And people who have been dealing this kind of a situation now in pandemic, that whether there is an income loss or maybe some reduction in income, but the expenses tend to remain the same, whether it's the EMIs, the rent, or the kids' education, or the household expenses. Is it really possible to build a portfolio where you have at least maybe 50, 60% of, because many of the people, they have suffered, let's say around 50% of income. Salaries have been reduced to half, at least for a certain period. So is it possible to bridge that gap with fixed income security?
No, first big picture, if your salary is reduced to half, you ought to reduce your expenses.
Okay,
I mean,
that's taken.
you really can't continue to spend more than what you earn, right? So
But then,
that's
there
one.
are some
What
expenses
you
which
have
are
saved
fixed.
in the, sorry,
Yeah. So,
go up.
no, I was saying that, the EMIs cannot be reduced. The rent cannot be
That's right.
reduced. And kids'
Yes.
education, the schools have refused to bring down the fees. What you can possibly reduce is your discretionary expenses. You used to go
Yes.
outside, eat in a restaurant, or you used to travel for leisure, etc. That anyway is not happening. But in terms of the bigger expenses, which is mostly the
Right.
EMIs and the rent, etc., they are not getting reduced. But the income, one has suffered a loss.
Yes, yes. No, I agree with you. I'm being cheeky here, but I agree that, lots of people are cutting on expenses also right now across the
Hmm.
world. But purely from a capital allocation point of view, yeah, I'll tell
Hmm.
you, when do we get salary cuts en masse? When there is a real serious macro problem, okay?
Yeah.
And that is precisely when, unfortunately, equity, which is our best friend for a long time, actually,
Hmm.
stop being our friend because the investment portfolio also see drawdowns or losses, okay?
Hmm.
And also keep that in mind that, when you're feeling ugliest about the world around you, that you're
Hmm.
actually seeing salary cuts, job losses in that period, equity is not being your friend. Okay,
Hmm.
it's the fixed income which will befriend you because it will still continue to deliver you fixed return. And in fact, in an environment like this, okay,
Hmm.
fixed income could potentially give you better returns because you will see capital gains also. Because
Hmm.
fixed income likes bad macro, equity likes good
Hmm.
macro. So in good
Hmm.
times, equity roared. In fixed income does well in bad times. Okay, so let's get that first. That very bad situation, job losses, is the reason why a lot of fixed income returns have been very good in last 1 year, 2 year. Okay,
Uh-huh.
gilt funds have delivered 15-16% return. Why? Because the situation is very bad. So that balanced your, as I said in the beginning, the
Hmm.
equity drawdowns. Okay,
Uh-huh.
yet, there are funds like low duration fund and short term fund, which are going to be your friend almost always, irrespective of, the macro. They will give
Hmm.
you relatively steady income in all times. Okay. So if you look at the sort of low duration fund, vis-a-vis fixed deposits, the standard deviation, the measure of volatility is
Hmm.
similar. Okay, so both the funds give similar, both fixed deposit and low duration have similar characteristics of market risk. And
Hmm.
as far as the credit risk is concerned, they're very well diversified and because they're short-ended, 3, 6 month, 9 month products, they don't give too much of shock to the investor. So I think low
Hmm.
duration fund, short-term funds, corporate bond fund, these funds actually are, funds for all times, good times as well as bad times in fixed income.
Okay. So, Manish, there is another question, and this is playing devil's advocate to what you said. Uh, People say that when everything is bad, when the newspaper headlines are like everything is crashing, that is the time when you should go to equities, right?
Yes.
And maybe because everything is down, so you invest at a lower base, whether directly or through instruments like mutual fund. But on the other hand, because of this income loss, etc., or because of the other factors, you're saying that fixed income is delivering better returns. So how do you then balance the two? It's a tough call, isn't it? I mean, on one hand, you're saying that times are bad, markets are beaten down. This is the time to pick up value. But on the other hand, you're saying that fixed income is generating better returns. So how do you really make that situation work for you?
No, Naveen, there was a contradiction in what you said and what I suggested. What I'm
Uh-huh.
suggesting is that, remember I told you in the beginning that, you need to have a friend who can help you balance your portfolio. Now,
Okay.
in good times, when markets are red hot and equity is doing very well,
Hmm.
perhaps you should review a portfolio and, go a little bit in fixed income so that you are prepared for bad times. In bad
Okay.
times when markets are bleeding, perhaps
Hmm.
you should rewire your money to equity a little more so that
Hmm.
in good it'll make you more returns. Okay, so that's the
Okay.
rebalancing part. Okay, so I am
Okay.
not suggesting that at this stage. Last time also we discussed 3, 4 months ago. I was arguing that equity will do very well over the next many years,
Hmm.
especially in the near term.
Hmm.
So I continue to believe that equity is a better asset class to own, but
Hmm.
here we are talking in terms of portfolio of an individual investor. I do not
Hmm.
know who am I talking to. I may be talking to a 75-year-old man, and I don't want to preach this
Okay.
idea that equity is a great asset class right now.
Mm-hmm.
He perhaps was 10% in equity. Okay.
Hmm.
My advice to him is that, sir, please try and take it to 15% right now. Okay.
Okay.
Because it's very likely that equity would do very well. Okay. Next
Hmm.
couple of years. So that's the rebalancing part. What I
Okay.
suggested is that what fixed income does in bad times is that it does good for you. Okay.
Okay.
But during bad time, you should still want to be wiring your money from, because you are doing well, that extra that you've earned, you could wire it back to equity. Okay. So
Okay.
that, eventually you will make more return. So in a
Mm-hmm.
sense, you have to play a little bit contra when, it's a very, very simplistic one and perhaps not the right one. Okay. But I'm just giving you a very basic trick, which you and I both understand
So.
and pretty much everyone understands at a behavioral angle. When there is far too
Mm-hmm.
much of panic, that is precisely an asset class, okay, which would perhaps do very well in the future. Okay.
Mm-hmm.
There's too much money chasing banking PSU funds today in fixed income. Okay.
Mm-hmm.
There is too much money coming in gilt funds today. These may not be the asset classes which will do very well in the future. Okay, so balance your
Mm-hmm.
portfolio. Okay, play a little bit contra.
Mm-hmm.
Too much panic in equity, place some money in equity funds. But our idea
Okay.
was that in bad times again, the fixed income allocation of yours will balance the drawdown. They'll balance
Mm-hmm.
the loss that you have. Your portfolio will bleed less because you are invested in fixed income. So we are not conflicting each other, making the same point.
Sure. So, I mean, I think then it's good to conclude that people who are well covered, they need to rebalance in a different way, maybe go more towards equities. And people who are not covered in terms of their income or in terms of their assets, giving them some regular money flow, they need to behave differently. And, we certainly take your point. Now, there are people, because of this job loss, etc., are looking at liquidating their investments. So it could be PPF, it could be EPF, which the government has now given some flexibility to withdraw on. There could be gold that people have. They are looking at selling that and meeting their expenses. So in terms of liquidating, what should come first? Should it be physical assets, if possible, like gold? Or it should be, assets like EPF, PPF that you should liquidate and try to meet your expenses?
No, if you are in low end of mutual funds, which is low duration fund or liquid fund, they are the
The
places where
first
you
one on
should
the
draw
list.
your money out from, because that is
Okay.
precisely why they are there. To give you
Absolutely.
liquidity when you need without giving you any shock. Okay.
Mm-hmm.
Gold has a very different purpose. Gold's purpose is, it's a zero coupon perpetuity. Okay.
Mm-hmm.
But you have to be careful. Gold has rallied a lot. Okay. So you may want to rebalance your portfolio, by reducing the exposure to gold now. I've been a proponent of gold for a very long time, but I think now gold is starting to look relatively expensive. So start to be careful. I'm not asking you to speculate on gold here. Then, go to 10%, 20% of your portfolio and bring it down to zero. If you are at 10%, maybe it perhaps makes sense to sort of reduce by 2-3%. Okay, to gold.
Okay.
Right now. See, the rebalancing is not about binary, ideas. Okay, let's all in equity, all in debt, all in gold. No, just sort of navigate it, through mild sort of upgrade or downgrade as far as your exposure is concerned across these asset classes. So that's how you should do it. But from pure draw, I mean, if you want money right now, if you're allocated in liquid, low duration, short-term fund, maybe they are the places that you should take money out.
Okay, that's a very important lesson and very important point that Maneesh has made, because if you have to withdraw money, your first thing on the list should be your fixed income mutual funds, where you had parked your money for such incidents which now are looking not ending very soon. So that's where you should draw your money from. But Manish, thank you so much for joining us today and giving us all this, not just information, but also the ways to deal with this situation. Appreciate your time.
Thank you, Naveen. Always pleasure to talk to you for all these pointed questions. I hope our conversation will be helpful to investors. Thank you very much.
Thank you, and I really hope that we also move towards financial independence. Maybe next Independence Day, when we talk about this subject, all these issues are not there. But you are also right that something or the other will come, whether it's A or B or C. But we need to be better prepared and educated to deal with such situations. And Mutual Fund Talk is the show which attempts to prepare you to deal with such situations. Thank you so much for watching the show today. If you have any suggestions or feedback, do write in the comment section, and we'll address those points. We'll speak to our guests on those subjects. But for now, we'll wind it up here. Thank you so much for watching. This is Naveen Soni, your host, saying goodbye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.